Disney beats Wall Street, but Trump and inflation data heat up bond yields. Welcome to Market Insight, I'm David Pollard. If the US election has been dominating the small screen in recent weeks, it's the big screen that has propelled Disney to street-beating earnings today. Blockbuster movie ticket sales for Deadpool and Wolverine helping the entertainment giant to an EPS of $1.14 for Q4, where $1.10 had been expected. Well, with me now is Anna Rathbun, CIO of CBIZ Investment Advisory Services. Anna, welcome. Let's start with Disney. We had good movie revenue numbers from them. Are those the strongest points in today's earnings report?
Hello, David. Actually, the price action today, certainly we had great earnings number from Disney, but the price action is really about future guidance. So Disney did something today that was we haven't seen from Disney, which is to give pretty clear earnings guidance, not only for 2025, but for 2026 and 27. So for 2025, they're telling us they're expecting gains of upper single digits. And for 2026 and 27, double digits. So this actually made the markets very excited. And the question is, what gave them such great insight into the future earnings? And, the film success that you talked about earlier, that actually has a flywheel effect. So if Deadpool and Wolverine and Inside Out 2, they have done well in the theaters, there are also going to be a demand for them in theme parks as well as cruises and also in their streaming service. So they're seeing a lot of clarity into the future earnings, and that certainly excited the markets today.
So how would you characterize broadly what you've seen across the board in this earnings season, and how do valuations look? One strategist said they were priced to perfection but in danger of overcooking. Are those your thoughts too?
Well, when you have the S&P 500 index with a forward PE earnings ratio above 20, and it's been above 20 for a very long time, certainly that's in the high valuation category, and I agree with the analysts. So the question from here on out is, will there be a price correction toward a more reasonable PE ratio levels, or will the earnings catch up? And that is a big question where there's a doubled enhanced uncertainty because of the potential economic policy changes that will be down the road in 2025.
Well, on that note, the Trump trade marches on with the dollar at a one-year high on higher yields and fears over what a Trump administration might do. Are higher yields likely to become a fixed feature now for bond markets?
Well, the short answer from our perspective is yes. There are market forces that are keeping yields higher, and we think that is higher for longer. Part of that is the U.S. debt profile. So with the Trump administration coming in, there's been a lot of talk about not only potentially extending the current tax cuts at the end of 2025, but also additional tax cuts. So that means more money in the economy, and those things are also inflationary. And also that actually doesn't help with the debt profile, which makes the cost of borrowing for U.S. Treasury potentially higher as investors demand higher yields for the borrowing. So there are things that are structurally built into a higher for longer yields scenario.
And how is the inflation picture in terms of what we've seen yesterday and today in CPI and PPI data? How's that playing into that sense of nervousness around price pressures ahead?
Yeah, it would have been great to see CPI yesterday continue to come down, but it didn't. It gave us more of a sticky picture. And certainly PPI, it would have been great not to have seen an upward tick, right? So this tells us that for most of 2024, inflation hasn't given us any sort of confidence that it's heading toward 2%. And going into 2025, when you have policies that tend to be inflationary, such as more money in the system, as well as potential tariffs that may be coming down the road, those things also don't give us confidence that inflation is going to head back down to 2% anytime soon. So we are looking at a higher for longer scenario also on the inflation front.
So what does this all mean for consumers? Do they now have to brace for more pain if Trump pushes through his threat of tariffs on trading partners? which does appear to be a fairly firm intention after the appointment of a known China hardliner as Secretary of State.
Yeah, so we have to remember tariffs are a tax, right? It's used as a tool for sometimes for negotiations, sometimes with actual policy intent, but it's at the end of the day a tax. So the question is, who is paying for that tax? There seems to be this belief, especially among China hawks, that when you levy I think right now it's 60% planned tariffs on Chinese goods, that China is going to pay for that 60%. But in reality, that is not true. It doesn't, you're not taxing the originating country. Historically, we've seen tariffs being levied across a time, many decades. And what we've seen is that those tariffs actually get passed down to consumers. And there's no reason to believe that it would be different this time.
OK, we'll leave it there. Anna Rathbun of CBIZ Investment Advisory Services, many thanks for sharing your thoughts with us today. That is Market Insight. Don't forget you can watch more videos on Reuters.com.